very pleased to introduce Nick Vita, Chief Executive Officer and co-founder of Columbia Care. Columbia Care is traded in Canada under the ticker symbol CCHW and in the US under the ticker symbol CCHWF. Shares are up 81% so far this year. Columbia Care is one of the most established and experienced companies in the US cannabis industry, having been founded in 2012. It is one of the largest cultivators, manufacturers, and providers of medical and adult use cannabis products across the US, with licenses in 18 US jurisdictions and the EU, and over 2 million transactions completed to date. Columbia Care continues to be a leader in setting the standard for professionalism, quality, care, and innovation in the fast-growing US cannabis industry. We believe the company is well-positioned in the US to benefit from near-term and long-term catalysts and has upside potential in its international operations, CNC card payment solution, and research pipeline. With that in mind, I would like to turn the call over to Nick, who will tell us more about Columbia Care and the opportunities ahead. Nick, over to you.
Great, thank you very much, Andrew, and thank you all for joining us today. As Andrew mentioned, I am the first employee, one of the co-founders and the CEO of Columbia Care, and I'm delighted to tell you a little bit about our story today. Just fast forwarding past the disclaimers, Columbia Care, as mentioned before, was founded back in 2012, and we were one of the first multi-state operators. Today, we have operations in 18 jurisdictions in the United States and the EU, with 73 dispensaries and 22 cultivation or manufacturing facilities. Trailing 12-month revenue is almost $200 million. And I think the thing that matters to us most isn't necessarily the size of the business, but the fact that we have such a high rate of return. So we have enormous degree of customer satisfaction and creativity that goes into the way we interact with our consumers. We've had significant growth along with the rest of the industry, both on a sequential and a year-over-year basis. In spite of the COVID headwinds, we saw 71% year-over-year growth on a top-line basis, gross profit increasing over 120% year-over-year. But more importantly, we saw a dramatic improvement in year-over-year adjusted EBITDA and gross margin. In addition, in the second quarter, we raised about, actually year-to-date, we've raised about $73 million, a combination of hybrid equity, debt, and other financing means, including sale leasebacks, that has given us one of the best balance sheets in the business. One of the things that we've always prided ourselves on at Columbia Care is that we have a very balanced business model. We have always been known for being the leader in health and wellness, and I think that will continue to be an area where we excel. But as our markets have transitioned from medical to adult use, as we've seen in places like Massachusetts and Illinois, Columbia Care has really been able to leverage that core competency at the operating level into very durable relationships with our consumers and really sort of expanded footprints, both from a brand perspective and a SKU perspective. We are known throughout the industry and among consumers as having one of the most important and sort of high-touch experiences at the dispensary level, and we consider that to be a core advantage, not only because it gives us a source of information and data that we're able to redeploy into decision making at the local and at the national level, but because it allows us to really understand what it is the market is demanding and how it's developing. So the relevance of the products we make, the branding, the architectures, the price points, all of those things, even the design of our facilities, is really a byproduct of the information we gather from our consumers. What that means is that we think about data in a variety of ways. First, from a product innovation perspective, we use our non-clinical IRB approved research collaborations to develop better products using the right combination of cannabinoids and terpenes to really develop both medical and adult use product portfolios to complement the different brand architectures we have. But in addition, we use the information to determine where we want to have our facilities, how we want to develop them, when we want to lean into things like home delivery or credit card, and when we want to really innovate rather than using the status quo. We've always been execution focused. We recently announced our first acquisition of an operating business in Colorado, the largest operator in the state of Colorado, the Green Solution. But for the most part, every facility we've developed on our own, and we've won those licenses through the RFP process. And what that's allowed us to do is really maintain financial discipline and sort of develop a very high quality pathway to return on invested capital. So rather than paying a multiple in other people's businesses, we've been very successful at creating the framework and the foundation for a national network, a cohesive national company, without necessarily spending a lot of other people's money to do it. And because we've been execution focused, it's allowed us to not only innovate on the product side, but also innovate on the service side. So when we look at the CNC card, which is our consumer credit product that's being rolled out beyond Columbia Care's four walls onto other MSO platforms this quarter, we're also looking at using that as a leverage point for our home delivery capabilities, our online virtual shopping experience called virtual.care, all of which have had extremely strong impact on our basket sizes, our revenue, our customer loyalty, and our profitability. Looking at the portfolio of markets we're in, I think one of the things that's important, it's not just the scale of the company and the fact that we spent the 2019 and the first half of 2020 building out all of our assets and all of our markets, so that today we have really just the opportunity in front of us to leverage those fixed assets. The fact is that we have more markets than any other company that are transitioning from medical to adult use. And as we saw in Massachusetts, where we're a top 2 player, or Illinois, where we're also a leading player, that transition creates huge organic growth opportunities. So going down the laundry list of states where we think that there is a possible changeover from medical to adult use, Arizona, Delaware, Florida, Maryland, New Jersey, New York, even Ohio and Pennsylvania, along with Virginia and Washington, D.C., have conversations happening at among different legislators and policymakers that could lead to a scenario where we see a dramatic change from medical only to adult use, which would be not only important from the standpoint of developing the business and from a financial profile, but really from the standpoint of the industry being successful and being recognized as a national asset at the federal level too. But it's not just that we have a big footprint or that we're fully integrated, it's that we do each piece of that chain very well. And so when we think about cultivation, the KPIs that we use and the data we provide our cultivators allows us to hit those KPIs. And so, for example, when we think about its grams per square foot on a dry weight equivalent basis, we target indoor grows for 65 grams per square foot on a dry weight equivalent basis per harvest. We have about 5.2 harvests per year indoor. When we look at outdoor grows in places like Colorado, it allows us to create a bundled average cost per gram on a dry weight equivalent, less than 35 cents going forward. So we've had not only a great deal of success in driving efficiency at the cultivating level, but also from a cost perspective and a production perspective, but also from a quality perspective. So if you look at our recent developments in the wholesale market in places like Illinois, we now have flower that's testing at 35% total active cannabinoid content. And that's among the highest, not only in Illinois, but in the country. So it's a combination of creating value by driving efficiency and offering better products, both on the wholesale and the retail side, and really stress testing and leveraging the continuity of chain of custody and supply chain. Complementing sort of our ability to grow and manufacture, we also have one of the largest networks nationally of dispensaries. And it's not that we have sort of dispensaries just in a hodgepodge group of areas. We have them targeted in all the areas where we want to be. So for example, in New York, we're in Brooklyn and Manhattan. In Massachusetts, we're in Lowell and Boston. In Illinois, we're in Chicago. And so we have a good balance between sort of very high density leading metropolitan areas, along with kind of secondary cities that are population centers, but may not be the state capitals or may not be the largest population centers in the areas. And that's given us the ability to create a very diversified revenue base and really sort of transact and build relationships across consumer categories, whether they be adult use or medically focused. So when we think about sort of how we sort of optimize that relationship with the consumer and how we build our own corporate brand and how we build market share profitably, really has to do with the types of products we offer. And so we have a suite of adult use products. We have probably the best combination of medical products in the space. We also have CBD products. So all the combination of all of the above allows us to really demonstrate and lean in a meaningful way to sort of command leadership within the medical space, to really perform exceptionally well when transition to adult use takes place, as you've seen in places like Massachusetts, and then really begin to build a reputation outside of the cannabis space through the traditional retailing footprint by using our CBD products, both in the US and in the EU. So all those create opportunities that are profitable long term that enable us to really leverage the investment we've made into the organization. So when we think about what what those efforts translate into in terms of four walls analysis or profitability, if you look at two examples, so for example, in place, when we think about the maturity curve for the performance of our facilities, our dispensaries, we have a general expectation that within 1 year, every one of our dispensaries is operating close to or at or above EBITDA positive on a four walls basis. So when you think about sort of Pennsylvania, which is one of our states, we're averaging an EBITDA margin of about 31% there. That 31% EBITDA margin is also complemented by significant sequential and year-over-year growth on a four walls basis. If you look at Prescott, Arizona, or even Lowell, Massachusetts, again, you're talking about north of 30% EBITDA margins at the dispensary level. But more importantly, when you look at the annualized revenue per square foot, you end up at a place that is exceptional for any retail setting, and you have incredibly good economics from an efficiency perspective. And so with performance like that at the operating level, we've had the confidence from the beginning of the year to basically set out guidance. And that guidance has been reaffirmed through the second quarter. We expect to see north of 40% gross margins in the fourth quarter on a consolidated basis. Revenue between 155 and 180 top line, and obviously adjusted EBITDA positive this year. These numbers actually exclude the impact of the Green Solution. So Green Solution is an EBITDA positive company. It has a fairly significant revenue base as well. So when that happens, obviously the guidance we've given on a pro forma basis is obviously going to be reaffirmed as well. So when we think about the way we consider sort of the growth prospects, it really has to do with sort of a parallel path of not only sort of driving organic growth and being positioned for that transition from medical to adult use, but also beginning to use the foundation that we've laid with the human capital leadership teams in market and the fixed infrastructure we've built out, and leveraging that into sort of, let's call it the M&A market. Our first acquisition, TGS, is a good example of that. It allowed us to really overnight become the leader in the second largest cannabis market in the world, in a profitable way. And the number one criteria we look for in acquisitions today are businesses that are well run and that are going to drive profitability, because with profitability, we will be able to capture market share and really leverage our cost of capital to become more aggressive at developing sort of unique and competitive advantages that are sustainable over time. And then finally, before we switch over to Q&A, I just wanted to highlight the management team. We have one of the most experienced management teams in the sector. This is the team that's been with us for the most part from the beginning. And Mike and I are the two co-founders. We still sort of get involved in operations day to day. And we've sort of learned along the way all the mistakes that a group could make. And I think that's one of the things that you really can't put a price on, because I think that we've been fortunate in that the markets have been very good. There's fundamentals to the industry have been very good. But as things become more competitive, that experience set will really sort of matter. And as we've begun to see in our own business, the ability for our chief operating officer and the chief financial officer to leverage the data that we're able to gather from the individual unit lines are incredibly valuable as we start thinking about continued margin improvement quarter over quarter at the gross margin and operating margin level. And you're seeing that pay off sequentially as you see our results published. And so we're very, very proud of the way we've been able to build that foundational infrastructure to really drive value long term. And then finally, I think one of the things that sets us apart is the fact that we have a board of directors that is among the best I've seen in my professional career. And I say that based on the fact that these are people who have exceptional experience. They have real governance controls. And so this is not one of the situations that you have seen traditionally in the cannabis sector where the founders can run roughshod over investors. Quite the contrary, we actually have one class of shares. We instituted a board with professionals so that they could provide real oversight. And we think long-term institutional capital will flock to that type of governance structure and that type of checks and balances. And ultimately what that translates into is that is a lower cost of capital. And our view is that the lower the cost of capital, the more likely we are to succeed and be able to execute from an advantaged position relative to our competitors. So with that, let me stop for a moment and we can sort of shift back over to Q&A.
Great, and thank you very much for that presentation, Nick, that overview. We will be switching to Q&A now. The audience who are logged into the Zoom platform can submit questions through the Q&A function. As mentioned, I will be moderating, and you will also be able to submit questions directly through me through email. So just the first one here, Nick. Just returning to the theme about catalyst ahead, you do operate in a number of markets that are medical only right now, but are very close to transitioning to adult use. When I look at your portfolio, New Jersey, New York, Arizona, what's your outlook on those markets transitioning, the timelines there, and what are you doing to prepare Columbia Care for that eventual transition?
Well, I think I would break it into sort of three distinct categories. The first category, actually, the existing markets. So, for example, in Massachusetts, we're going through the process with the city of Boston to co-locate our adult use facility right there in downtown Boston. That's a meaningful catalyst for us when you take into account the amount of productive capacity we've built out over the past couple of years and the type of success we've had in Lowell. Being able to sort of leverage the Boston metro area from an economic perspective and from a brand and operating perspective will be meaningful. I would say the same thing in the city of Chicago, where we recently received approval for our second Chicagoland dispensary. We are expecting our expanded existing Chicago dispensary to be fully completed by sort of the end of next month, and our second Chicagoland dispensary to come online. In the second quarter, we had our first wholesale sales, which are beginning to ramp up in earnest right now, which are going to be meaningful from a cultivation and manufacturing perspective. So you have real catalysts that are going to be worth hundreds of thousands of dollars a month or a week in some cases, and that's going to obviously aggregate into a meaningful impact on the business. So you can even look at markets like Ohio and California, where we just started selling in the wholesale markets. But those are existing markets with no sort of immediately visible catalyst, other than the fact we have capacity coming online, and that capacity has an enormous amount of demand. So that's one group of catalysts that are happening, and those are meaningful. So I'll pick on one more. Florida. We just announced that we had our first harvests at two different cultivation facilities. Those two facilities and those expansion programs that were basically going through the completion process in the first half of 2020 are going to be able to produce somewhere in the neighborhood of about $50 million a year of dry weight equivalent flower. And so these are not small numbers that we're talking about that are actually coming online that will allow us to not only provide ample supply for our existing portfolio of dispensaries in Florida, but allow us to open 4 more in the second half of the year. And so when we think about the incremental sort of investments we've made and how we've deployed our capital and the types of return we expect to receive on that capital, that translates into a very, very profitable and attractive story for investors. Second tranche is really the tranche that you were talking about, which is the groups of states that are transitioning from medical to adult use. I would use New Jersey as a perfect example. We are in the process of building out all 3 dispensaries. Our first dispensary is open. We've already had our first harvest, but we're actually expanding our cultivation and manufacturing capacity materially for the rest of this year. So by the time the legislation passes and actually the program is online, our goal is to be one of the leaders in the state of New Jersey, period, end of story. And you look at New York, we're making the same investment there. You look at other states, we're making sort of incremental investments across the country in all those markets because so many of them are transitioning. And then the third category are the sort of the markets where you really haven't heard a lot. So, Virginia, Utah, Missouri, all of those are very interesting markets to us. They offer significant upside in 2021 and a sort of solid base towards the end of 2020 in the case of Virginia, because you have 5 operators, but you have a population that is, roughly the same size as Illinois. And what's interesting about it is that for the first time, you've seen a southern state with real bipartisan support for an expansion of the medical program to include all the products you've seen in a place like Florida. And so, you imagine that competitive dynamic against the type of market opportunity that exists in places like that, and all of a sudden it becomes really interesting. And those are just organic, sort of execution-based opportunities that we can scale into. And we haven't even begun to touch on the sort of the M&A markets, which we continue to see as being very attractive in all of our core states.
So a lot going on, no shortage of things going on. We do have a question from the audience they want to ask. They were hoping you would be able to expand on the CNC card and the potential for upside there. I would just like to build on that question too, and ask, with the Safe Banking Act passed through the House of Representatives, how might that piece of legislation impact your CNC card and plans for that product?
So, candidly, we don't really build the impact of the CNC card into our business, although it has been impactful. We built the card because we thought it would be a very important way to provide consumer access to credit, which they have in every other consumer product other than cannabis. And what we found is that the impact to average basket size was material, north of 20% increases. It impacted the repeat business for home delivery. And so what we plan on doing is effectively building that business outside of Columbia Care, splitting it off so that it basically becomes a call option for our shareholders that becomes worth something. We've had a number of conversations with large players. We've actually gone through a rebranding process so that it can be basically white labeled for all the other networks that might add this platform onto their own. And more importantly, we've created a uniform loyalty program so that people can effectively buy from us or anyone else that uses this card on their platform and collect those miles. And as we've seen in every other example, from sort of precedent perspective, that's a very important sort of driver of consumer behavior. From the safe banking perspective, it's unclear to me who's going to win the election at both for there's enormous amount of controversy for the battle for the White House and for the senatorial races, and I just don't think anybody really knows what's going to happen, and I think that creates a lot of uncertainty. So even if, for example, there was some sort of uniform agreement at the House, of the Senate, and the White House to pass the SAFE Act on its own outside of another sort of legislative vehicle, it would take a long time to figure out what those regulations actually mean. And that's the period during which we think we can really sort of take advantage of providing consumers with sort of a normal course transaction structure rather than having to use cash or a debit card. So, in the worst case scenario, it's still a very attractive opportunity to create strategic value and immediate value for the participants in that space. In the best case, it's something that may last a year or two, maybe even more, before you have any meaningful competition. And at that point, you have a competitive advantage from a data perspective and from a market perspective. So that actually has strategic value, we believe, to the more traditional credit card players, because this is a different fee structure. It's a different financial opportunity for a consumer credit provider. But in addition, it also creates a lot of continuity. So, for example, in markets like California, where there are no sort of transaction intermediaries, and you have effectively working capital killing most businesses, being able to use an electronic transaction platform that is actually robust and reliable is something that I think there's real value for when you think about the leakage that occurs because people have to use cash as a method to transact.
Awesome. I think we have time for one last question, just over 3 minutes. So it's going to be, this one's going to have to be a little bit brief. But I just wanted to ask on TGS and in Colorado. We have a question from the audience whether the gross margin profile of that business is substantially different than the gross margin profile of the existing business. And I also wanted to ask if you could perhaps maybe talk to us a little bit on how the consolidation of TGS, once that closes, will help potentially provide benefit in some of your other markets.
Certainly. So, look, we are still going through a phase of development where our gross margins are going to see sequential improvements for the foreseeable future. And you've seen that in the first quarter, you've seen that in the second quarter. I think you'll probably see it in the third quarter and beyond. And that's just because we had so many facilities that we were building out that were coming online. So the existing comparison is that TGS has a higher gross margin than our own. Now we hope to be able to add scale to their platform and frankly leverage their brands, some of their vendor relationships, and vice versa, so that we can take their know-how and export it to the rest of the United States through our market network and really prepare for adult use, because we think that's going to be an important stage of development before the regulatory changes actually occur. But it's a significant contributor from an EBITDA perspective. TGS already generates EBITDA, so we think that from a financial perspective, it'll be materially positive both on the revenue and let's call it the EBITDA level. It'll be substantially positive from a strategic perspective in terms of giving us leadership in the second largest cannabis market in the world. And then it'll also give us substantial benefit from a human capital and from a kind of a brand perspective, because they bring with them a portfolio of brands that are already quite well known, that have a variety of pricing architectures and branding architectures that really appeal to different parts of the market that maybe historically we haven't been as strong in. So it's a very nice fit between sort of the left hand and the right hand to sort of create that combined entity that still maintains leadership in the medical and health and wellness space, but also has among the best adult use sort of talent and brand portfolio in the industry.
Nick, thank you very much for joining us today.
Sure.
Excellent overview on the company, and we look forward to participating in future upsides. So
Great. Thank you very much.